Welcome to This Week in Money. I'm Jim Goddard. Today, CIBC Wood Gundy's Ross Clark comments on capitulation in the gold mining sector. New York Times bestselling author Marin Katusa warns Russia is elbowing Canada out of the Chinese energy market. And Kaiser Research's John Kaiser believes overregulation is strangling hard-pressed junior miners. We'll talk to Ross Clark right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600. Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark, investment advisor at CIBC Wood Gundy in Vancouver. Welcome back to This Week in Money, Ross.
And it's nice to be with you, Jim.
Even the New York stock markets are looking a little shaky now.
Yes, the one market that had been holding in was the U.S. equity market. It had some leadership with biotechs, healthcare, and the U.S. financials doing pretty well up until a week ago, and starting to see a little bit of a rollover now in those, coming down to test their breakouts and looking a little bit antsy on that pullback. The breadth of the market has been pretty poor down there. We know how bad it's been in Canada. It's been very bad up here. But in the U.S., you've been running on the S&P this week. We had a number of days with 4% new highs and new lows consecutively for 3 days. That's a very unusual circumstance. You tend to see that around distribution patterns. So the market looks as though it's vulnerable for a little while here. We're sitting around the 200, just under the 200-day average on the Dow, shade above it on the S&P, and they were down testing that earlier in the month. Saw a poor bounce, and we're probably going to see some trouble now. The other side of the water over in China, we had that good bounce off the 200-day moving average. We're looking for a 50 to 60% retracement, a little ABC style of rally. That would be, one leg up, a pause, and then a second leg. And as of Thursday of this week, looks as though Shanghai hit the top end of that bounce, and it's probably due now to work its way back towards the lower support, regardless of what the officials there want to have in the market. The reality is that it's starting to look a little bit tired again.
How are precious metals doing?
Well, as we move through the spring, it was that consolidation phase that we were talking about, where typically when you've had the hard break, you then have the break in oil, and then precious metals go into this consolidation for 3 to 4 months. And as they move out of that, if the inflationary pressures are kicking in and there are anxieties, you will get a breakout. But this was one of those years that late June we started to slide through support. 2 weeks ago we started to move through that 1140 level on gold, and this was the week of the really hard break. Got down into the 1070s in gold. So it's now retraced a full 50% of the rally since the 2000 bottom down at $253. Type of reminiscent of some of the other hard breaks we've seen historically. Back in the 1970s, you saw this kind of a break. And the commitment of traders numbers released on Friday, finally starting to show bears really coming out of the woodwork, and the long side positions for the speculators being reduced. We're down to 28,000 contracts now for the specs on the long side, 21,000 for the commercials. Those are the lowest levels that we've seen in 3.5 years. Put it in perspective, the figures were up around 120 to 130,000 back when we had that rally into January. So the degree of the speed of the break here in those numbers is short-term bullish for the market, and our proprietary signals that we have that look for capitulations and exhaustions, kicking up a lot of capitulation signals in the last 48 hours here. The stockcharts.com, which does an analysis of stocks that are uptrends and downtrends, had the sector with absolutely 0% bullish reading. as far as the miners were concerned in the precious metals. So probability of a pretty decent bounce here. Don't think it'll be the final low in the precious metals, but we could see a relief rally in the next couple of weeks.
Looks like the price of crude is under pressure again.
Yeah, the same idea. Commodities in general easing as the U.S. dollar has been strong. Oil had that break from the 62 level down to 50. A pause there, and that pause ran about 2 weeks in what we would call a flag pattern. That's where you have a post and then a flag. So in this case, it was the hard break from 60, consolidation in the 50 to 52.5 range, and we're in that next leg down. I think most of the street that has got the oil market right in the last couple of years are looking for a retest at least of the $42 level that we saw earlier this year, and the estimates for the lower numbers are starting to come out of the woodwork again.
Ross, thanks a lot for talking to us.
Yes, Jim, and we'll be with you in a week from now.
My guest has been Ross Clark from CIBC Wood Gundy in Vancouver. His email, ross.clark@cibc.ca. And Ross will have a special report on gold this weekend, so check out his email if you'd like to get that report. Coming up next, Marin Katusa on This Week in Money.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Marin Katusa, founder of KatusaResearch.com and author of the New York Times bestseller, The Colder War. Welcome to This Week in Money.
Always a pleasure.
What is going on with our colder war right now, Mr. Putin versus everybody else?
Well, the trend continues. Putin's dealing with lower oil prices, lower commodity prices, but his expansion with the BRIC banks, the relationships with the Chinese have continued moving forward. So this is all positioning in a multi-year battle that I call the Colder War. And you look at the contracts now that the Chinese and Russians have further advanced. You'll see further contracts announced in Iran, with now the sanctions being lifted in Iran. It's not going to be the U.S. firms that are going to benefit from this. It's going to be the Chinese and Russian firms that are going to be first mover advantage because of the support and relationships they have with Iran. So even though the oil markets have been tough for Putin and the commodity markets, so there's no questions there. He's moving his agenda forward, and the alignmentship with the emerging markets, they have no choice but to work together against the established forces of the U.S. and the developed world.
How scary is that for everybody?
Well, I'd like to think that things are going to move in a better way. Hopefully, with the sanctions being lifted in Iran, we won't see a nuclear arms race or a military race in the Middle East. However, Saudi Arabia has already started making moves, investing into military equipment both from the U.S. and Russian side. So hopefully we don't see an arms race, but it does look like it's starting.
Who are the Saudis arming against?
Well, they're preparing against the Iranians. There's no question that, the Saudis are not happy with what's going on with Iran, but at the same time, they're painted in a corner. They have to move with the force of the Americans because the Americans have decided under the leadership of Obama that this is something that is the right thing for the Middle East and the global markets. So, Obama made it public that he would veto any sort of attempt in the Senate for blocking the lifting of the sanctions with Iran. So Obama's committed to this, and the Saudis are, for now, going along with it.
Could OPEC turn its back on the U.S.?
Well, even if the OPEC turned their back on the U.S., it wouldn't really matter. The U.S. are a major producer now, and the importance of OPEC right now for the Americans is nowhere near where it was, say, 30 years ago during the oil crisis. So it's not about whether OPEC will turn its back on the Americans. It's more about, will China turn its back on OPEC and further align itself with the Russians and the Iranians? For example, in the last 9 months, the Chinese have doubled their imports of Russian oil and have decreased their imports of Saudi oil. So when Iran comes back online at the point where they can, expect another 1 million barrels in the next 20 months, within the next 24 months. Expect another 1 million barrels coming from Iran, and most of that's going to go to China. So, China's looking to diversify itself from the main OPEC players such as, Saudi Arabia and Kuwait and UAE and the others.
Has Canada blown its chance to be a major oil supplier to China?
Yes, in the near term, there's no question that we should have had these pipelines built 5 years ago. It's going to be a tough go for the Alberta oil patch. The existing production in the oil sands, I think, is going to do just fine because the big capex are up front. So the oil sands, most of the market thinks is going to shut down. I disagree. I think it's going to do just fine. Don't expect any new production coming online in the oil sands, but it's the higher cost producers that are in debt, that have U.S. debt in Alberta, that I'm worried about. And you're not going to see the growth that you need because a lot of the sedimentary basin needs north of $80 oil. So yes, it's true that a weak Canadian dollar helps the Canadian producers, but be careful about the debt. Is it U.S. debt? Is it Canadian dollar denominated debt? So be careful if you're an investor.
Would a pipeline through the Mackenzie Valley north help Alberta oil?
Well, good luck building that. That's been on the table for a while. I think building any new major CapEx programs is going to be difficult because we've missed the window of high-priced oil, and now everyone's looking at, efficiency rather than big CapEx programs. So it would definitely help. There's no doubt about it. Any pipeline, any alternative route is good for Canadian oil. But getting it built on time and on budget is proven to be an obstacle.
What about a pipeline from Alberta to Ontario? Is that possible still?
I think it's possible, but do I see it happening in the near term? No, I don't. Even though the Brent oil is trading at a premium to the WTI price, it would have been a fantastic thing for Canada to have this done 3 or 4 or 5 years ago. In a sub $50 oil market, there's cheaper oil that's going to come out of the Middle East that can, compete with the Canadian oil. So I just don't see it being a priority or being done in the next couple of years.
Are people looking to uranium as the fuel of the future?
Well, definitely in the emerging markets. You look at Saudi Arabia, signed up 16 reactors. You got Japan committed to bringing back their reactors. China's going to be moving forward with their reactor plans. They got 26 coming online in the next few years. You look at Iran, they're going to be building up a nuclear program they announced with the Russians. India is now announced a stockpile of uranium. So definitely in the emerging markets, you will see a growth for nuclear energy. And in the developed world, they're going to sustain what they're using because the capex to replace nuclear energy is just too large. People have to understand that nuclear energy is the most reliable, clean, baseload power that exists. Hence why America for the last, 50 years has had 20% of its baseload power, 1 in 5 homes, from nuclear power. You look at France, over 50%, over half of their homes, baseload power, are generated nuclear energy. That's not going to change. That's here to stay.
Should BC lift its moratorium on exploring for uranium?
Even if they did, nobody would care. It would become a too high cost producer in this market. My old good friend Ron Netoliski developed the big uranium asset here in BC, and it's just a high cost producer. So even if BC lifted the moratorium, the investment dollars wouldn't come because there's better assets in the U.S. that are positive to uranium, that are a better place for the investor and speculators' dollars.
What's the future of the Canadian oil sands?
Well, I think it's going to continue. Like I mentioned earlier, existing production is going to do just fine because, again, just like in the nuclear industry, oil sands is an upfront. If you're talking about conventional production, you're looking about high upfront costs. That's going to continue because their sustaining costs are lower. So as long as oil stays in that, above $40, it's going to do just fine. If oil crashes to $20, that's a different question. I do not see oil dropping down to $20. Any new conventional production, I don't see it because you need north of $80 to $90 oil for new production. SAGD will continue along as they bring more efficiency, more innovation, as the service sector gets better at what they're going to do. So I think it's going to do just fine.
What's the future of LNG? BC did sign that 25-year agreement. Was that a good thing or bad?
I think it's a great thing, but like I've said for the last 5 years, it's a bubble waiting for a pin to pop it. I haven't put a single dollar on it, and everyone who's invested in it has done horribly awful at it. So I've always avoided the BC, kind of like the coal markets. I've avoided coal, LNG, and BC. They're just too late. They're behind the Americans, who are behind the Aussies, who are behind the Russians and Qataris. I got a whole chapter in my book about it, and there's just better places to put your dollars. It's just too little, too late for the BC LNG sector.
Is U.S. shale going to also be a big competitor?
Definitely. I've stated for years that the U.S. shale sector is real. It's here to stay. Innovation. They've dropped. If you look at what's going on right now, the Americans produce almost as much as the Russians do in natural gas. These are these are the leaders in the world, and these are world-class assets. Production's costs are going down. In the last 12 months, the production cost per barrel of shale oil has dropped about $20 per barrel, and it's going to continue. Innovation through necessity. So I don't see that trend changing, and U.S. shale is here to stay.
Does China have a lot of potential shale as well?
China has significant amounts of shale, but again, the area comes into cost. Part of the advantage of the U.S. shale sector is existing infrastructure because of their complex conventional production. So the Sichuan Basin is probably the best shale formation in China, something I wrote about 5 years ago. You see the majors like Halliburton, Schlumberger, they're all there doing service contract with the Chinese. And they're going to develop those assets, but it's not open for, the American markets or the Canadian junior speculative market. That's not open for it. So what you're seeing there, a lot of people don't realize that China is a major oil producer too, and they've increased their production in the last 12 months. So China recognizes that they need to develop their own resources. They're a major gold producer, they're a major oil and natural gas producer, and they're going to continue that trend.
Is that something that's been ignored? We always thought China was just a consumer of our products.
Well, they are a consumer of our products because they need so much. Now, the Chinese are at 13 million barrels a day of what their refining capacity is. The Americans are about 18 million barrels, and the Chinese are number 2. That's going to grow slow and steady. The Chinese use over half of all the coal that's produced in the world. They use about half of all the copper that's produced in the world. That's where the growth has been for the commodity markets. Now, if China's sloth grows down, which it has, that's why we're seeing such suppressed commodity prices. And with a strong U.S. dollar, that's very difficult for the emerging markets, so you'll have less growth and even more pressure on the commodities. So it's something I wrote about a year ago, talking about why we're going to see pressure in the commodities. So, we're in a very globalized market, and you've got to pay attention to what's going on the other side of the planet on your resource investments.
I know China has expressed an interest in weaning itself off coal to reduce its air pollution, but will they be able to meet those targets?
Targets are political agendas. Will they meet them eventually? Yes. I wrote about 2 years ago, I wrote about the apocalypse, in China. It's a tough place. Go for a run in Beijing, and you're going to be coughing a lung out. So, as I am right now in my office in Vancouver. So, they're diversifying. They're doing a lot of green energy investments. They're making significant investments in nuclear energy, which is the cleanest form of baseload power, in my opinion. So they're going to do what they can. But again, remember, all these things take time.
Will China ever be able to fill all those empty cities they've built?
I think, yes and no. For example, a lot of that was speculative, just like we're seeing a big correction in their stock market. It's a very speculative market. Gambling is illegal in mainland China, so whether they speculate in the stock market or in the resource market, there's a big speculative demand. Eventually, just like in any boom town, whether it's in, Fort McMurray or in the Eagleford, when things are hot, it's great. When it's not, people are going to lose a lot of money, but eventually growth will get there.
Was China right to change its goal to turn to a consumer society rather than one that produced goods?
Well, that's the natural cycle of every emerging market where they want to go. So I think they're not getting away from a nation that's producing goods. They're still producing many goods for the world, but they're also trying to develop their own market. And I think they're going to continue that until they get away from, becoming an exporter. A big question is, what are they going to do with the yuan, because it's pegged to the U.S. dollar? That's a big question. So as the demand for the yuan grows, that will be an interesting aspect of when China switches and maybe perhaps starts buying up more resources to develop their country. So, the government of China well recognizes that the worst thing they can do is have a major economic collapse, because that would be rioting. So expect the Chinese to do whatever it takes for their economy to continue.
Is that why the Chinese government urged government firms to buy back shares to prop up their stock market?
Definitely. It's no different. It's just a different form of quantitative easing. We look at that and think, oh, how could they do that? Well, wait a second. What did our Fed do here in North America? You look at Canada. You look at all-time highs for real estate. Really, should the government of Canada be reducing interest rates? Go ask the average Vancouverite who's trying to buy a home. Because of these low interest rates, there's so much speculation in our markets. This is a ridiculous real estate market. But people are accepting it because it is what it is. And you look at look at Australia. Their dollar to the U.S. is $1.37 today. Talk about a fall from grace. And it's going to continue because they're so resource oriented. So what that's going to mean is it's going to be good for exporters in Canada, but it's going to be very, very bad for the exploration companies who need to attract capital, because, you're not going to get it. And look at the resource sector. Look at all the vacant mining companies that are now trying to become marijuana companies or a tech company or a biotech company. There's a lot of zombie companies out there. And if you look at the financial statements, there's over 1,000 companies on the venture exchange with less than $500,000 in the bank. Those are even worse than zombie companies. These are like zero companies. I'd call them an uncompany.
You had an interesting comment on your website. Why would Hitler have loved the euro?
Well, that was an interesting, I listened to a lecture, and it was, it's a fascinating concept of what Hitler tried to achieve. Awful person, awful things that they did. And yet, you look at what Germany has done with the euro and what Angela Merkel has done. They have been able to essentially take over the euro without firing a single shot. And hence why the ledger could be much more powerful than the strongest military campaign. And it was, it's interesting. That article, I spent quite a bit of time really going through the history of it, and it got a lot of people uncomfortable. And that means I'm doing something right. So if you look at it from the Greek perspective, what's next? You got Spain, Portugal, Italy, France. The euro's in a lot of problems. It's in a lot of trouble. And yet, Germany's been able to consolidate power there. So, it was an interesting way of looking at things, comparing the last big German onslaught onto Europe versus what's going on now. And rather than military, it's used its ledgers.
Right. Instead of soldiers marching in, it's been guys in suits and ties.
Even more lethal, eh?
Well, the same result. Are they literally taking over Europe that way, the German banks, by taking over all these debts?
Sure. Well, look what's going on in Greece. They're going to have to sell the state-owned assets to the Germans. So it's no different than when the fall of the Soviet Union, rather than selling it to the banks, a few oligarchs were able to pick up the power. Well, do you really think the average Greek likes a German right now? There's a lot of animosity there. There's a lot of frustration. And, at the end of the day, he with the gold is king. And right now the Germans are powerful, and they're going to continue because of the laws set up, and the German government is in a position to dictate the terms. So they have the upper hand.
Marin, thanks a lot for chatting with us.
My pleasure.
My guest has been Marin Katusa, founder of KatusaResearch.com. Coming up next, John Kaiser on This Week in Money.
This Week in Money is archived online at TalkDigitalNetwork.com.
My guest is John Kaiser from Kaiser Research Online. John is a mining analyst with over 30 years of experience. Welcome to This Week in Money, John.
Jim, it's a pleasure to be on the air with you.
It won't be long before you're in Vancouver for the Sprott Stansbury Resource Symposium. Can you maybe tell us about it and what you expect to do at the symposium?
Well, this symposium pulls in a number of both high-level newsletter writer commentators as well as industry executives who are all going to be sharing their view of what's happening in this current market where there's a huge bear rate on commodities and what one should be doing and looking forward to going forward. So it's going to be very interesting because at the moment everything seems like it's coming to an end, and we literally are in a blood in the streets situation that everybody says, well, this is when you're supposed to be in the market looking for the good stuff. And of course, nobody ever feels like doing that when we do see blood in the streets.
Now, is this still a period where we're seeing a lot of consolidation, a lot of takeovers, and have we reached a point where maybe it's the end of that and now it's just mere survival?
Well, the terrible thing that happened in starting late May and early June is that commodity prices have sagged dramatically, and this has pulled down all the mining companies because there's now suddenly a capitulation washout. Everybody's dumping the producers because they're seeing gold price going lower. Gold is now below 1,100. Copper has dropped below 240. There's all this bad news about China's stock market bubble collapsing and the ripple effects this may have throughout its own economic growth projections. So there's this massive pullback out of the resource sector, and the juniors, which have already been suffering in a downtrend since 2011, they are now just being crunched. Many of them are so cheap people aren't even bothering to sell them. They're just sitting there idling and in the pennies. Rollbacks are still being done, but there's very little new capital coming in. Some of the companies with assets are now being merged into bigger companies. Even companies that have a lot of cash and no really good project assets are also being merged together to create bigger capital pools. There is a massive shrinkage of the pool of viable companies underway right now.
At the symposium, will people be coming up with possible solutions?
Well, I can't speak for the others since I don't know how they will have changed their views in terms of all the predictions about how gold is supposed to go to the moon when in fact it isn't doing that. It's going to be interesting to what they say about that. My own perspective is I'm saying we're not going to see much help in the broader resource sector from base metal price uptrends. It'll be a couple years. There may be a select metals such as zinc, which has a depletion cycle affecting its future supply, so we could expect higher prices from that. In terms of gold, until gold bottoms and turns around, it's going to be something that nobody wants to have anything to do with. There's this huge anxiety about what higher U.S. interest rates will do to the U.S. dollar and hurt gold further. In fact, I think that gold is already discounting, even over-discounting the effects of higher interest rates in the United States. And I think we will not see the U.S. dollar rise significantly after the interest rates start to rise. So that may give gold a bit of a help along the way. In my view, in this type of bear market where you aren't getting any obvious help from metal price trends, traditionally the junior sector has been bailed out by an exploration discovery that comes out of the blue. But what concerns me this time around is that the very little capital is going into the corporate treasuries, so companies are very reluctant to spend what money they have left when it isn't clear that they can replace it if they get anything short of a barn burner, no-brainer type of a discovery hole. And the other thing that I'm telling people is you have to look for security of supply type stories where perhaps demand for some metal arises because of some new technology usage for it or geopolitical disruptions. Say things go wrong in China and tungsten stops flowing from China to the rest of the world, then the rest of the global economy has a tungsten supply problem, and juniors that have tungsten projects would benefit. And then I'm also looking at very exotic spaces such as scandium, which is a metal of which there is pitiful supply right now because it has all come from byproduct, and there are deposits discovered in Australia that completely change the economics of supplying scandium to the market. So there's niche opportunities like this where no matter what the general market does or even the global economy, stories like that can flourish based on their own fundamentals.
Are juniors with good results seeing any price appreciation?
No. For example, at best they don't go down. You need really, really spectacular results to get any sort of upside that stays. If you get encouraging results, the sort that tells you you're in the ballpark, you're not there yet, there's very limited interest in the stock. An example of one that I have followed recently, Uravan Minerals, which has been one of my recommendations. They pulled a proof of concept hole in the Athabasca Basin for a potential uranium discovery. It's not the discovery yet, but it's the culmination of a decade of scientific work by management to show that they have a way of looking through the deeper covered parts of the basin and seeing evidence that uranium deposits are at depth. And this would be a huge revolution for the Athabasca Basin because all of the good ground is owned by juniors, private parties, and even majors. But where the unconformity gets deeper, they're at a loss as to how to prioritize a target for drilling and raise money. So here's something that could breathe life back into an old-fashioned Great Canadian Area play, but the market is so paralyzed that this stock went from all of 10 cents to 14 cents and is sitting there on very little volume.
How do you attract the money to invest in exploration where that might be the way to get the whole market moving again?
Well, one of the things that's happening now is the stronger groups, the serious groups that are out there. They may have sold off their flagship company. They haven't been in a hurry to do anything since this bear market started happening in 2011. They are now poking around, looking at all the corpses in the battlefield, and looking for ones that are alive and have potential to be resurrected. And so we're seeing these companies undergo substantial rollbacks, often with a subsequent price decline. But the new groups are coming in, they're putting in money, they're cleaning up the debts, they're adding additional, people, manpower where required, and they are gearing up to revitalize the projects. The ones that are most interesting to me are the ones that are discovery exploration plays, because I think the institutional audience is going to be absent for quite some time, but the retail audience, which to a large degree was absent in the last big sort of metal super cycle based cycle, I think they have a potential to come back into old-fashioned discovery type plays. So we're starting to see this. It would help if somebody came up with a big discovery to remind everybody that great things can happen. Some 10-cent stock can go to $3-5, and everybody who bought it for all the right reason can make money as a result. That's what's missing from the space right now, and I'm watching for groups coming into these juniors and turning them around.
John, is there going to be a way to get the junior market going again? Are regulations holding it back, or is that just an excuse?
We're seeing a lot of activity by the BC Securities Commission nitpicking on technical reports that have been filed for economic studies. For example, First Quantum, which is a major copper producer, recently had to refile a technical report because the nitpickers found something that wasn't completely in compliance with the 43101 rules. And these things are kind of an annoying distraction, but they're not really the problem. The problem, I think, is how do you get money going into corporate treasuries, especially the smaller companies, not the bigger market cap ones that Bay Street likes to finance, but all these juniors with relatively low market caps. The sophisticated investors they're not in great abundance right now. The trend is all wrong. And retail, in BC at least, there is an attempt at an exemption where a non-accredited investor can do a private placement, but they have this ridiculous rule that you're supposed to own at least one share before you give the money, are entitled to do a private placement up to $15,000 in the junior. The problem with these juniors is that the market is fragmented. They have multiple order execution platforms. First come, first serve principle is violated. They have a culture now of proprietary traders who function as capital strippers who monitor for when any sort of buying comes in response to encouraging results. They compete with existing shareholders to sell non-existing shares short, and they can lean on the market when the buying runs out to stampede existing shareholders into selling when they see that, the news is not so good. The stock's price is going down, therefore it must be bad. I better bail now before it goes lower. And so you have this great big sucking sound happening here where any capital comes in, gets stripped out. Price gains are not sticky for the juniors that are having progress. And none of this is being addressed by the regulators. They have their heads in the sand with regard to making reforms in this regard.
Is it much like a traffic cop handing out tickets when there are no accidents being caused, but they just hand out tickets anyway?
Well, that would have to do with these 43101 revisions that they are fussing about. The irony is that most of these projects are not worth anything because the metal prices have sagged below the base case prices. And here they are nitpicking about this detail or that detail. It's the equivalent of a college professor who fills a student's essay with red ink without questioning the fundamental argument in the story. They're just concerned about citation and proper grammar and spelling and vocabulary and all this sort of stuff. That seems to be about all that they are doing. Yes, totally useless.
Are there any juniors getting financing right now?
There are a few. For example, one of them, NextGen, managed to raise $27 million at 50 cents a couple months ago for their uranium project in the Athabasca Basin, where they are intersecting high-grade uranium north of the Patterson Lake South discovery of fission uranium. So that was quite stunning. But in terms of a broader range of companies, there's these little small $200,000 financings, which is really just staying alive money that insiders are putting into the company so that they can pay the accountants and the listing fees and all these other things that have to be paid or you get suspended. We're seeing very little capital going into these companies for exploration. One stunning exception was Skeena Resources, which raised $8 million at the price of about 6.5 cents without a warrant. And this is going to the Spectrum project in northwest BC, which is an older gold project that fell victim to the NDP government declaring a park in the area where this deposit or project was located. And Ron Nedolitsky, who's famous for finding deposits, has brought this into the company, and they now have a drill program going on there to demonstrate that what was near surface extends 800 meters down to the valley floor, and they're hoping to show that here's a sort of medium to high grade gold system. Minimum target is 1 million ounces. Ideal target is 2 to 3 million ounces. It'll all be underground mine, but it's the sort of system where even if gold's slopping around at $1,000 an ounce, this type of project would be of interest to the market. So that's the sort of stuff one should be on the lookout for and focusing on right now, where you can get a news flow that shows, yes, the bigger picture is happening, the bigger picture which the market right now is refusing to price into the stock.
Do the accredited investor restrictions make a discovery play less likely?
Yes, because we have a situation where companies, 500 companies have market caps below $1 million, and And so you can't raise substantial capital without going for shareholder approval and risking all these takeover rules. So these management teams that are generating interesting prospects that need maybe a couple $100,000 for a geophysical program that becomes the basis for a drill program, they can't get that money from institutional investors because it's all early stage. And the sophisticated investors right now, they don't see the aftermarket potential. They see this all as just lottery tickets. So they don't want to put their money into these exploration juniors. Retail is the audience that has the time to do their homework, to understand the story based on the company's presentation and that, and maybe put $10,000, $15,000 into a treasury. The company has to, scrabble it together from maybe 20, 30 retail investors. But if it gets that money in, it's at a valuations that are very cheap, and if they start having success, the retail investors would be very well rewarded. And many of these companies are rolled back, so these retail investors can't buy any meaningful stock in the market because liquidity is so poor. So it would make imminent sense to allow retail investors to bankroll these companies directly.
Do you ever see a time when the junior resource sector will again see happy times?
I'm very concerned that we are facing the end of an era, the death of an ecosystem. Now, it sort of looked like that in 1999 when the dot-com bubble came along. Bre-X had blown up in 1997. Metal prices were weak. Gold was heading towards $260. And we got bailed out in 2003 with the emergence of the super cycle that China unleashed. And against the whole financial crisis backdrop, we saw gold come out of the gutter and reach a high of 1850 or so before retreating, giving up almost 50% of that gain. There is no super cycle possible for at least another decade. India can't do it. Its GDP is too small at this stage, and even with 10% growth, it would be 10 years before it reaches the tipping point. So nothing in the immediate future from super cycle type trends. Gold is the wild card. It's a very emotional metal. It's the one thing that could bail us out, though hopefully not in a context where we have another global financial meltdown, because in that sort of case, even if gold goes up, there's not going to be any capital available for the junior sector. I think we need the discovery exploration, but I'm concerned that with brokers no longer really allowed to recommend or even allow their clients to do unsolicited orders in these companies, the gateway of capital into the treasury from retail investors is choked off. And with these other rules, we cannot get a discovery exploration play going like we did in the 80s and 90s and the bear markets that we had then, where we always got bailed out by a wonderful discovery that had replication implications.
Do you think the regulations kind of laugh in the face of what made Canadian mining great?
The regulations are geared towards a sort of banking establishment agenda to collect all the assets of Canadians and administer them according to textbook portfolio diversification strategy and collect a management fee, 1 to 2% on the value of the portfolio and maybe a percentage of the upside it experiences. And what they really end up doing is putting you into a collection of structured products that kind of emulate the random walk of the market. And what we're seeing now is Roboadvisories emerging, which are going to charge a tenth of what the banking establishment is doing, and they will robotically manage your portfolio according to the same rules that the bigger groups are coming. So I call it like strapping the Canadian investor into a rocking chair and feeding them pablum. And with the boomers now in their fifth year entering retirement, this is the audience that traditionally understood the junior exploration speculation game. They are now being strapped into rocking chairs. They're not allowed to play in this arena. They are, of course, very, very anxious about whether they'll have enough money for their retirement future. And the younger generation, if they want to do gambling in the market. They can do it with volatility trading and ETFs in the foreign exchange market. There's many other simpler ways to lose money gambling in the market. So it's kind of almost an obsolete type of speculation form, and that's a sad thing because the exploration sector does create new wealth. This is what generates new ideas, which opens up new areas to explorations, and even with all the failures that they generate, many of them will be the deposits that get dragged out of the closet 30, 40 years from now when we are in a different world with much higher demand. And then these failures that the junior generated that weren't quite good enough will be acquired and put into production by future operators. And this is being killed off in Canada.
John, thanks a lot for chatting with us.
Jim, thank you very much.
My guest has been John Kaiser from Kaiser Research Online. His website, kaiserresearch.com. That wraps up our show for this week. I would like to thank our guests, Ross Clark, Marin Katusa, and John Kaiser, and thank you for listening. Comments or questions for This Week in Money can be emailed to info@howestreet.com. I'm Jim Goddard. We're back next week with more This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.